Welcome back to the Money Under the Mattress podcast. My name is Mitch, and my co-host is Jake, and today we are joined by Kris, also known as From Value to Growth. Kris is an author on Seeking Alpha, where he has more than 25,000 followers on. He is notorious for writing up on potential multi-baggers, which I'm sure we'll get into later on. We're excited to talk to him today about Seeking Alpha, potential multi-baggers, as well as how to grow in the investing community. So thank you for joining us today, Kris.
Happy to be here. It's from growth to value, by the way.
Oh, sorry. I messed up on my wording there.
No problem.
But yeah, we're really happy to have you on today and talk a little bit about from growth to value and Seeking Alpha. So usually what we do is for every guest that comes on, we always talk about how they started in investing. So would you like to go a little more in detail about that?
Sure. Well, I don't have a background. I mean, a family background of so in investing. And actually, I am from Belgium. So over here, a lot of people everywhere, but people are sometimes conservative, and especially here, the stock market is seen as gambling. A lot of people think that the stock market is gambling, and my parents thought about that as well. My father had some shares as an employee of a Dow Chemical, so Dow company, and those shares were actually quite a good example of that. One moment they were at 55 or so, and the next moment they were at 9 because of the financial crisis, and then they went back up, etc. And if you don't have a background in investing, you think it's completely strange, and those stocks just do something. You cannot control that. And then in 2013, my wife was pregnant, and that incited some sort of primal feeling of having to gather. And my very first instinct was, I have to gather for this child, and this unborn child. And my very first idea was collecting single malt whiskeys, because I organized single malt whiskey tastings back then. Not on a big scale, but I did that from time to time, so I knew quite a lot about whiskeys, and I knew that you can invest in them. But my wife didn't think that was a great idea. She said, "Oh, you will drink from those whiskeys," and I said, "Well, I'll buy 3, and one is for me, and 2 others are to invest." And she said, "Well, that's 1/3 of your investment that has gone already." And yeah, well, you got a point there. So and then I thought about collecting art, but you need quite a lot of money to do well, and also I'm not a real expert. I'm very interested in art, but not a real expert, so I would have to learn a lot as well. I did that for months. My wife was not enthusiastic about that idea as well, and then I stumbled upon stocks and started reading about them, and my wife was not really enthusiastic about that idea as well, but I could convince her by saying, let me just start with 50 a month or so. And she said okay. And as most new investors, I think I made a lot of mistakes the first 2 years. Fortunately, it was not that much money per month that it went up after those 50, but it's best that I listened to my wife and I didn't start with all our savings, because that would have been a disaster. And when something doesn't go right, you can have 2 reactions. You could say, I don't care anymore, or you can go deeper and deeper and deeper. And that's what I did. I really wanted to know why, it didn't work out for me, why I failed. And I started reading ferociously, listening to podcasts, reading books, etc. And then, start I discovered Seeking Alpha, and started reading a lot of articles there. I mean, probably an average of 15, 20, maybe 25 a day for a long time. And because I read so many articles, I also started making comments, and I started seeing, at first, if you're a new investor, you read those articles and you're very impressionable, and you cannot make the distinction between a good and a bad article because they all sound convincing, right? So, but I learned that by reading so many articles. I saw that, especially about the same stocks, I saw that some people are more right than others, right? And I started making comments, and those became more and more frequent and longer. And at a certain moment, somebody said, I follow you on Seeking Alpha because I think your comments are always so interesting, and they're almost as long as the articles sometimes. Would you start writing articles? And I thought, well, yeah, maybe that's an idea. I didn't feel completely ready, so it took a few more months, and then I started writing, and that was in May of 2016 when my first article was published. And from there, I continued what I was doing, the same thing. Continued to study a lot, listen to podcasts. Study always sounds so vague, so it was always reading articles, listening to podcasts, reading books. Not just purely investing. I have always been a ferocious reader from when I was a kid, and I saw more and more books that I could apply to my investing, even though they were not about investing directly. I mean, for example, the books of Nassim Nicholas Taleb, The Black Swan is a famous one, but Anti-Fragile is a very important one, or was a very important one for me. Unscaled by Ahiman Tunisia is another one that I apply to my investing. It's not directly about investing, but he's a VC guy, so he has a background. It's about unscaling the world, where scale used to be an advantage. It has become a disadvantage, and so that's where I continued my journey then on Seeking Alpha, and then I launched Potential Multibaggers. I started the series actually in was that May of 2017? I think so. So that's when I picked the first potential multibagger, and that was Shopify. So it was at $77 back then. So it's it's a huge winner, of course. It's a 20 bagger or so. And when I started out writing, I picked my name From Growth to Value, because I had been a value investor before. And at that moment, I started, transforming, because I got the idea, if you have a growth stock, and, I'm a long-term investor, and you hold that growth stock for a very long time, it becomes a value stock. Look at Microsoft, for example, or Apple. I mean, even Google, Facebook, etc., etc. So if you have a great growth stock, Amazon is, for me, almost a value stock now. I'm sure a lot of value investors won't agree, but if you look at those kind of stocks, those great stocks, and you hold them for a very long time, they transform from growth to value. So that is actually what I was already in that, or transforming into in that period. So that was quite a long answer, right?
So you discussed a little bit, I've seen on other podcasts, how did you go to school for writing or journalism?
Well, I was a teacher, so I was a teacher of Dutch and English. So Dutch is my mother tongue, and I studied well, Dutch and English first. And then after that, I did an extra year of media and communications. And then I started as a journalist. I started working for a local TV station. Did that for about a year, a bit more, and then I started working in the Belgian Parliament, actually. So that was something completely different, but not so different at the same time. And again, it was the same thing that attracted me, the constant studying, because, of course, if you work at the Parliament, it's a lot of, legal things that you have to do. And I had no background in that except for some, media. And well, that was it. And I had to study all of that. And, I really enjoyed that. But, once I knew it, I got bored a bit. So after 3.5 years, I switched to teaching. And that was actually meant I could get another job, but I had to wait for 5 months or so, and I didn't want to wait. Didn't want to be unemployed, so I started teaching, and I liked it so much that I did it for 15 or 16 years. So before I became a full-time investor and author at potential Multibaggers. So
interesting. And you discuss over in Belgium how a lot of people look at the stock market as gambling. Is it as regulated as it should be over in Belgium that you feel, or do you feel that people even believe that in the US it's also gambling?
It's heavy regulated. It's over-regulated, actually. For example, there are a lot of American funds are not available here anymore because all the papers have to be in Dutch and French and German to be available in Belgium, because those are the 3 official languages in Belgium. And for a big American fund, it's not worth it to make those costs to translate all those papers. So it's over-regulated, and the level of English here is quite high for especially in the Flemish part of Belgium. So I mean, in Europe in general, it's changing a bit now, but in general, people have always been afraid of stocks, and there has been a huge spectacular fail here. Leonard and Houseby, which was a speech technology company, and went bankrupt in 1996 because of fraud, etc. So a lot of people lost a lot of money back then. So that didn't help. So, and then the dot-com crash, that's the financial crisis, and people are just afraid. And in the US, it's a bit different in that sense that people have to rely more on the stock market for their when they retire, and that's not completely the same here, or it's just small part. And the retirement, people get money from the government when they retire, and that amount is higher than in the US. So they don't have to invest that much to get enough money. So that also plays a role. There's no there's no tax here on stocks. I mean, there is a high tax on dividends. So it also makes more sense here if you are a growth investor. I mean, if you are a value investor, there's a a 30% extra tax. What I mean is there's already tax in the country of origin, and then 30% extra tax on the dividend. So it's you can ask that back, that 15% in the country of origin, but that's very difficult administration. So if you are a value investor, you got to stick to, or most people stick to Belgian stocks then, because that it's just 30%, which is still very high. So that also is also something I think is important as a context here.
What are some of the key things you look for when trying to find multi-baggers?
That's a really big question because I look for a lot. In general, the bottom line is always quality above everything else. So and the very last thing I look at is price. So that's also something. But if all the rest is great, price doesn't matter that much to me. So what do I look at? I have a lot of potential multi-baggers characteristics. I look for high revenue growth. That's very important. Why? If you look at the best stocks ever, they you can go to examples. Walmart in the 70s and 80s. You can go to Amazon. You can look at Netflix. You can look at all the great stocks in history. They have always done so well because of revenue growth, not so much because of how much they already earn, but how much they grow. And if you look at it more theoretically, there are several studies that confirm that as well, those examples, that revenue growth is the most important factor for long-term stock gains. So if you look at, there are several studies there, but over a 10-year period, revenue growth accounts for, depending on the study, but more or less 75% of the stock return, while valuation only accounts for 1%. So I think that if you're a long-term investor, that it's very important to look at revenue growth. Now, of course, revenue growth can be bought. I would never buy Uber, for example, because if you look at the unit economics there, you see that they really buy their growth and their margins are very, very low. And maybe then they can get there with extra services like food delivery, etc. But the core business is not interesting. High revenue growth, but the quality of the revenue growth is also very important. So that's without that, you will never become a multi-bagger. Or at least it is possible, of course, in the market, but you'll never become potential multi-bagger big. So high revenue growth of quality. Management is very important. Too many people want to quantify everything in investing. You cannot quantify everything in life, so you cannot quantify everything in investing as well. How are you going, to rate each other as, a friend? Are you going to put a number on that? I hope not, right? So that's the same thing in investing. You cannot quantify everything, and people are so important. It's the people who build the companies, right? So I always look at management, what they say, how they say it, what they do, their employees, what their employees say about them, etc., etc. So management is very important as well. Also, I want management that has skin in the game as well. So they have an important stake in the company. So if the stock doesn't do well, they don't do well together with us. That's also very important. I look for, is this company set for a future trend? And for example, I look at that unscaled factor that I already named. Is this a company that, appeals to everybody in person? Let's take Coca-Cola. Coca-Cola used to be, one brand and that's it. And everybody was happy and wow, we have Coca-Cola. If you look at the number of brands that they have collected already, that's huge. And every now and then they do something very smart, and they bring cans with names on the market. Or maybe Starbucks is even a better example. Your name is written on that cup and it becomes personalized. And something that becomes personalized is always better. People in this age want something especially for them. They don't want, what everybody else has got. They want something that appeals to them, to their needs, their wants, their desires. And that's also something I always look for. So if you look at one of the better picks I had done as well, Roku, that's personalized TV. You really can make it your own TV, as it were, and that will even increase. I mean, if you guys say, we want a Roku channel, well, that's possible. You just have to go to them and say, hey, we want a TV channel, but we're not that big. We cannot do this on our own. Probably you'll have to grow a bit, but at a certain moment, I mean, it will be feasible for you to have your own channel, right? And that's completely individualized. And the same goes for Shopify. It's not, you can sell stuff on Amazon if you're a merchant, but you will be one of the many people there. You don't have any control over your brand. You don't have any control over the customer experience. While if you build your shop on Shopify, you can control all of that. And that's so important because people want that. People want to be treated as an individual and not somebody of the masses. So that's also one of the things that I really look at. And then that there's what I call the 3 O's. So overachieving is the first one. Overachieving is, if you look at what a company is saying, it's almost ridiculous. The best companies of our time have goals that are, if it can be ridiculed easily. I think of Cloudflare. Their mission statement is to make the internet better. Well, you can laugh with that, but they're really doing it. So they have big goals, and they really work on those goals, and they make progress. So the 3 O's. The first one, overachieving. What was the second one? Well, the third one is over-delivering. And over-delivering is quite simple. They always do better than you expect, time after time after time after time. I just checked it, yesterday, and Shopify has beaten on revenue each and every time since they're a public company. And they became a public company in 2015, if I remember well. So in each quarter, about 20 quarters or so, they have beaten on revenue. They have also beaten on earnings, by the way, every time but once. So, but especially that revenue is very important. Why? Oh, by the way, the third O, I had already mentioned that's owning. So let's go on with so 3 O's: overachieving, owning, and over-delivering. So let's go on with over-delivering. Why is it so important? It's so important because, and that's something that I still don't hear a lot of people talk about. A lot of people know the compounding effect, if you talk about investing, it's still not intuitive, but they know it, right? But if you look at earnings beats, they compound as well, and that is not really talked about. And I did the exercise. If you have a company which grows at 25% each year, revenue, right, for 10 years, and then that company beats the expectations by, I don't remember exactly, was it 6.7% each year, which is quite high, but not unattainable. And, for example, Twilio announced its earnings on Thursday, and they beat by 11.7% or so. That's very high. So for revenue growth, I think it was 6.5, 6.7. All right, take 7% on average that they beat, and after 10 years, you get double the revenue of just meeting the expectations at 25%. So those earnings beats really compound over time, and I think that's very crucial to understand. And a lot of people say, well, this stock is crazily overvalued, and that often has to do with, if you look at those stocks, you'll see that they often beat time after time after time. It doesn't mean that stocks cannot be crazily overvalued, because sometimes they are, but for me, in my experience, it's often more of the exception than people think. So those were just a few, but of the criteria that I use. But I could go on for probably another hour just about this, what I look for. So my subscribers always get a really thorough analysis when I pick a stock. It's 5 articles, 5 long articles. So yeah, those are a few of the subjects in those articles.
So you say that, I believe what you said is it's really only 1% of your actual time spent is on the actual valuation. Am I correct on saying that?
Well, I didn't really say that, but in general, yeah. Well, it's the very, very last thing I look at. Yeah.
Okay.
So in time spent, yeah, probably it's 1%. Yeah.
Okay. So because I've seen that you have a conviction level of 0 to 10, and you put a rating on it. Does the valuation ever change, the conviction level ever change based on the valuation of it? So if you think that the intrinsic value of the actual, let's say Shopify at 77, you think the intrinsic value might be, let's say $200 at the time, will your conviction level be higher, or would it just stay the exact same based on if the intrinsic value was 80, let's say?
I mean, I don't work with intrinsic value because it's so very subjective. I heard somebody say, and I haven't remembered, what he said, but not who said it. It was about a discounted cash flow, and I used to do them. I mean, it's simple. I mean, for me, it's quite simple. Or I used to do them when I started out, and somebody said back then, or several years ago, I heard, a DCF is like a telescope. Move it just a little bit, and you're in a completely different universe. And it's so true. I mean, a lot of valuations take some number. Why? Well, because the guy who does the valuation thinks that is a great number, but who says that guy is correct? And that guy was me. And I'm always very critical about myself. And if I looked at the results and I look back 2 years later, and I saw what I did, and I was so wrong. I mean, was that because my assumptions were ridiculous? Of course not. It's because my assumptions were subjective, because there's a huge range in which a company can fall, and those, for example, the earnings beats are almost never in in evaluation, but you should compound them as well. And that's just one of the things. A company can acquire another company and do great. How will you factor that in? How will you factor in that Amazon will not just sell books? How will you factor in that at the time when the iPhone was released, analysts said, well, they would have to sell every single phone in the world, to justify this valuation. Well, they don't, but there was a huge trend towards mobile phones, which analysts didn't expect. So there's so many factors that you cannot control, that you cannot foresee. I mean, yeah, I think most analysts could think of Amazon going into toys and into CDs and into movies, but not the everything store that it is today, or AWS, or all those other initiatives of the greatest companies of our time. And that's something which is, you really have to know that you cannot know the unknowable. And you have to be humble there, and not think that you know better than the market. I'm not saying that the market is always right, and sometimes there are clear errors, but I think in general, if you look at Amazon, and again, people have called Amazon ridiculously overvalued, until maybe 2-3 years ago, for probably 20 years or so. And that's also something that you see in most great stocks. Walmart at the time was called ridiculously overvalued. And they grew their revenue by triple digits in the 70s. So it's I mean, I have said to people before that I think I'm not smart enough to do good valuation, but it's actually because I think you cannot foresee what the future will bring. And if you look at the quality of a company, I think it and all the rest, all the criteria that I look at, I think those are more important often than just valuation on itself. So I don't do this company is worth that much. I can say sometimes, I think this is a bit too expensive. Yeah, but it will not change my conviction level, no, because who am I to be, to pretend to be smarter than the market? There was I don't remember. There was a mathematician somewhere in the early 20th century, and he went to fairs, and there was an ox, and people had to guess how much the ox weighed. And individually there were really ridiculous guesses, but he saw that if you took the average of all the people guessing, that was pretty close each time. So I think in general the market will be the same. Again, there are exceptions, but people see too many exceptions in my opinion.
We're just going to take a quick break to talk about the Quartr ad. So Quartr is a new way of doing company research. Their first mission is to enable access to conference calls, investor presentations, transcripts, and earnings reports as frictionless as possible, straight to your pocket. Their second mission is to create a completely new way for companies to reach their investors and vice versa, to change the way people look at investor relations. Their initial core product is now available for iOS and Android, but stay tuned for additional features during the coming year. Quartr is 100% free. They include companies from 15 markets today and plan to add more during the year. They prioritize requested companies, which you can easily do in the app. They have a lot more in store for the back half of the year, so make sure to follow them on Twitter at Quartr_app. That's at QUARTR_APP. Again, that's QUARTR_APP. Now let's get back to talking with Kris. Interesting. Yeah, because a lot of the people that we have on do valuation. They think that the market is very irrational on certain circumstances, obviously. So it's interesting to take a different take on different opinions on that. You go back to discussing some of the reasons that you can foresee a potential multi-bagger. Do you ever have an investing checklist when you're looking at them?
A checklist as in yes, no, I don't, because I named some of the criteria that I use, and I mean, I think there's a lot of there's too many binary options in and quantifying, and I prefer looking at reality and not just a binary yes or no. I mean, there's so much more between black and white.
Okay. Yeah.
I mean, there are you. I'm not saying that all a good. If you have a checklist, I think there has to be room for nuance in that checklist. So with a scale, not just yes or no.
Yeah. I would agree with that. I personally don't really use a checklist. I've tried it out before, but I find it really hard, especially when you're trying to put, like, let's say if you're evaluation or I evaluate, let's say a media business, and then I use the exact same checklist for a tobacco business. It's like, it's two different industries and totally opposite, differentiates. So it's hard to put everything back into like one funnel. With a yes or no answer. So yeah.
Sure. And that's one of the things, for example, that I mean, if there are value investors listening, and probably there will, I mean, one of the things that I have the feeling that they do not always understand is exactly that, what you say now, that it's a software as a service, a SaaS. Companies can be very expensive, 20, 30 times sales or more sometimes. But I think that's just because of the industry those companies are in, and subscription revenue is the highest quality revenue there is. I mean, it's much more reliable. If you have a subscription, you just let it on and you let it go. And especially if companies really need your product, SaaS companies or products are often very, very sticky and at the core of companies' infrastructure. So, and on top of that, their margins are extremely high. It's just software, right? So their margins are often 80% and higher. You cannot compare that to, even to Apple, which has a gross margin of 35% or so. So it's a completely different business, and that for each industry, you have to look at other things. So yeah, I mean, that's why a general checklist, if it's very, if it can be adapted very easily and it's broad enough, but you cannot say it cannot be more expensive than this, or it should have this, or this gross margin, or this profit margin, or because it depends so much on the industry.
How do you typically generate your ideas?
I have a very long list of 450 stocks that I follow up, not very closely, but in general. How do they come there? By reading articles, by often when a stock IPOs, I always look at it to see if I'm interested in or not. I usually never buy an IPO because there's still too much uncertainty there, and being a public company is a different thing than being a private company. So I want to see companies perform under the public eye first, and at least a few quarters. So, but I put them, if I'm interested, I put them in a list, and I follow up that list, and that's how I generate. I never pick a stock that I got to know yesterday. I mean, I follow it for months and months and months, and that's how you get a feel of how management is, how happy customers are, how happy the employees are, etc., etc. Because I think that's crucial information.
Do you ever generate ideas from 13F filings, so from other investors, and seeing what exactly they're investing in?
No, I don't. No.
Some people
I never read them.
You never read 13. Okay, yeah, that's where me and Jake and I'd say get a lot of our ideas from, and then honestly, like Substack, Seeking Alpha, there's a lot of ideas through there.
Yeah, well, I that's what I say. I read a lot of articles still, and there are great ideas, in Substacks indeed, on Seeking Alpha, Motley Fool. There are sources, Twitter, of course. There are sources, to generate the ideas. But again, I never, get a new idea and next week is my new pick. So that won't happen.
So you currently have over 25,000 followers on Seeking Alpha. What are some of your tips that you have for, let's say, early writers, or to publicly, I guess, give their intel on a stock or their opinions? What are some of those tips for the people that are starting out?
Well, I think it's very important to, those followers were never a goal or so. They just came by doing what I did, and I think that's very important to start with, because if you really want to work to that, and that's your goal, and your goal is monetization of those followers, I don't think it works that way. I think it's the other way around. It's about passion. It's about getting better and wanting to to become the best investor that is inside of you, and doing that publicly, with all authenticity, which I think is very important. I mean, I have made mistakes and I don't hide them. To the contrary, and I've sold, I think, 5 potential multi-baggers. I've picked 23 potential multi-baggers, and 11 are already multi-baggers. So they can already shed that potential because they're at least 2 baggers. But I have also had I had to sell 5, I think. And there were big losers. Weibo minus 55% when I sold it, or something like that. I think that was the biggest loser. But they're still in my list because I think it's very important that people see that. And in general, I mean, don't act as if you know everything. Dare to ask people as well, and always be very polite in your discussions as well, because again, the same thing, who says that you are right? Maybe you're wrong, and you always have to realize that if you have an open mind, you'll learn much more. And I think people appreciate that, because that's the kind of people you want to hang out with, not the ones that always think they're right. And too many people see it as a contest of being right. I see it as a contest of learning as much as possible from everybody. And even if somebody has been wrong 20 times before, maybe that person has one crucial insight that can help you. So, I mean, yeah, I think it might help that I was a teacher, so I wanted to help my pupils as well, or my students, I have to say, because there were 15 to 18. But I think I still do the same thing, and a lot of people ask questions. I answer them, and by answering them, I'm getting a bit smarter as well, because maybe there's just a little detail that I hadn't paid attention to, or just by the best way to remember something. If you study, if you're a student, the best way to remember something is to teach somebody else. If you look at how much you remember, if you just and I'm being a teacher now, but if you have a test tomorrow and you start studying this evening, how much will you remember in 1 month? Well, a test, you just start studying you learn it by heart, whatever. After 1 month, you'll remember 10%. If you teach that same subject for the test, after 1 month, you remember 85%. So, by teaching others, by responding to questions, you learn a lot, and you hammer it home for yourself as well. So I think that's, interaction is extremely important. Being friendly, being there for, as on Twitter, I have somewhere around 54,000 followers. If there's a question, I try to answer, even though there are so many questions.
Yeah, oh, sorry to cut you off there, Jake, but like when I started writing my Substack, I'm only I think I've only written up on one business so far publicly, but I've found that, yeah, teaching has helped me a lot, just in the process of generating ideas, as well as potential questions that will come my way. And then the questions that come afterwards, that also helps, I find, a lot, just to get a consensus on the actual business.
I think those questions often push you to look at it again because you missed some details, or there was one thing that you didn't go into, which may be important. And I write a lot of updates on the companies that I also own all of the companies that I pick, and it's also for me, I want to say, for me, as I want from my CEOs, right? I want to have skin in the game myself. I'm not going to say, well, pick this stock, but I won't. No, it's, I want to be there and feel the same thing as my subscribers. I want to, if a stock goes down 30%, even though I am, the one who recommended it, I have my doubts as well. Was I right or not? And that's the same doubt. My doubt will be probably less, and sometimes completely zero. But it's not the same thing if you judge it, on paper, than if you see it in your own portfolio. So, and I really want to be aligned with my subscribers and feel the same things and help them there.
So, how do you construct your portfolio? Are you fairly diversified, or are you more on the concentrated side of things?
Somewhere in between. So I own about, I don't remember exactly, somewhere around 30 stocks or so, 30, 32, something like that. How do I construct my portfolio? I have 3 buckets actually. And I think it's, first and for all, how you invest is very important to think about thoroughly. What I mean is, I started out as a value investor. And why did I change? Because I have always been someone who is extremely enthusiastic about new developments and forward-looking, optimistic, etc. And I think that, for me, with my personality, growth investing makes more sense. Other people are maybe a bit more, conservative, and growth investing is maybe not something. Maybe they are more afraid than excited. So and that's okay. I mean, I don't get it if people say you have to invest like this. You have to invest like your personality is like. your portfolio should reflect who you are, just like, you know, your books should reflect who you are, right? And for me, I have three buckets. So I have potential multi-baggers, budding anchors, and anchor stocks. And I will explain what I mean by that. So potential multi-baggers are stocks that I think have the potential to go 10x or higher over the next decade. So that is, 26% more or less per year. So a CAGR of 26%. That results in 10x over 10 years, or higher. Then you have budding anchors, which I think have the potential. They're already a bit bigger. They have the potential to go 5x to 10x, maybe more. You never know, but I think they will do at least 5x. I will give you an example. One of my holdings there is a DocuSign, for example, right? Or Peloton. And then I have anchor stocks, and anchor stocks are stocks that I think will beat the market over the next 10 years, but not go 5x. Maybe they could double or triple. They do a bit better than the market, but they're bigger. They can anchor down your portfolio a bit if there is a crisis. For me, anchor stocks still have to beat the market, so I still want above average revenue growth. And for me, I will name a few of my anchor stocks: Adobe, Salesforce, Amazon, those kind of stocks. If some of my subscribers ask me, is Microsoft, is Apple a great anchor stock? Well, I think it could be, yeah, because then you also have to factor in the dividends, etc. So they could beat the market, but I'm not so sure about them. So I don't invest in. How do I structure my portfolio? More or less, I take some 70% in potential multi-baggers, some 20% in budding anchors, and some 10% in anchor stocks. At this moment, it changes a bit, but it's more like that most of the time. Of course, the potential multi-baggers often grow faster, and that's why they have gained substance in my portfolio. That's how I structure my portfolio. I never sell unless the thesis fundamentally changes or I was wrong or whatever. So, for example, I held on to Baozun, Chinese stock, for I think almost 4 years or so, and I didn't see enough innovation to become a great company. So that's why I sold it, for example. So that can be something, or the industry changes. That's also possible. There's a new competitor that wipes out everybody else. So that's how I construct my portfolio. Several buckets there. But again, I have subscribers who say, yeah, but I want some income as well. So I'll take some dividends stocks as well. Sure, why not? Again, I think your portfolio should reflect who you are, and you can have as many buckets as you personally want. And I think that's very important. And diversification is quite important to me, because I've seen too many people being too sure of themselves. And I'm pretty bullish on my top positions as well. Of course I am, and but I'm bullish in that way that I just let my stocks grow. And C Limited, for example, has been a great winner for me as well, and it's probably it's my biggest position, and it's probably around 12.5%, something like that. If it would become 20%, I would still be okay with it. I wouldn't trim. But that's personal. Some people, might, lie awake at night when a position goes over 10%. Well, I mean, sure, it's your portfolio. Do what you think is best.
So for initial weightings, do you have a distinct percentage into every business? Like, let's say, you have a high conviction on this XYZ stock. So I'm going to put, let's say if I have a 7 or 10 conviction, I'm going to put this percentage, or is it really just on how you feel, what your cash position looks like at the time, or if you're willing to sell a potential bagger for a better potential bagger? How does that work?
No, well, let's start with the end. I don't sell. I don't sell winners. I only sell losers. I add to my portfolio every 2 weeks, and I scale in very slowly. I mean, the fastest position that I have taken over that time, I think, is C Limited, and it was 3.5 months or so. That was extremely fast for me. Usually I scale in much slower, 9 months, 12 months, sometimes even 2 years. It depends. If you look at my original allocation, it depends on my conviction, but I normally don't go higher than 8% of my total portfolio. Yeah, that's about the only thing. But it can be 1% for quite a while if I am not sure about the developments I see. I'm not the stock is down so much, I double down. I don't do that. I mean, I add to my best positions. I don't add to my losers, except if I know very sure that there is for example, last year in March, Square tumbled and tumbled and tumbled and kept falling, and I kept adding because I know Square very well. I know what it is trying to do, and I know that it's not even halfway there of what it can become, and that's why I kept adding, and I really pounded the table for that one during the March crash last year. But I bought as much as I could back then, because I saw that this is not based on fundamentals. This is based on fear. And if you see that, grab the opportunity. And sometimes you see a misunderstanding of the facts by certain analysts, and that can hammer down the stock as well. And then I Pinterest lost 25% last week. I think that was not warranted at all. Why? Because the only thing that they didn't beat was monthly average users. If you look at their average revenue per user, it went up by triple digits. And they're still very, very, very early in monetization. If I know what's coming, I know the pipeline, I know what they are rolling out. I know that one of their tests makes people buy 7 times more. I mean, if you all know that and you have knowledge, and that's actually what I do at Potential Multibaggers. I see myself as a filter to block out the noise and to look at what is essential. And if you look at Pinterest, the noise is the stock price drop, and again, then the stock price drop is a generator of more noise, and because people want to explain things, oh, but this and that and that, and they always have an explanation. I mean, if it goes up or if it goes down, they always have some explanation to soothe themselves, and they often judge on stock price action and not on fundamentals, because they probably don't know it well enough. And that's what I do. I, try to know my companies, or the stocks that I have picked, the companies of those stocks. I try to know them as good as an insider, or maybe even better, because I have the advantage of being an outsider and looking in. So yeah, that's how I think of that. Fundamentals above everything else.
Do you find on average that your highest conviction, best ideas do better than the rest on average?
Oh yeah, sure. Absolutely, yeah. If you look at my highest convictions stocks, they have done great, but also I mean it's the chicken or the egg, of course. My conviction has become so high over time because I see such good developments there, and at the same time the market sees that as well. So it's all intertwined, of course.
Interesting. Well, thank you very much for coming on today, Kris. It's been great to discuss potential multi-baggers, as Jake and I are kind of growth at a reasonable price. That's our whole, we're kind of GARP investors to a degree. It seemed pretty interesting on some of your write-ups that I've read up on Seeking Alpha. Do you want to just explain to some of the listeners where they can find you?
Yeah, so you can go on Twitter and find me at From Value, or you can go to Seeking Alpha and type potential multi-baggers or From Growth to Value, and you'll find me.
Awesome, Kris. So thank you very much for coming on today, and we really appreciated it.
It was a pleasure being here.
Thank you for listening to this episode of Money Under the Mattress. If you have any questions about this episode, you can email us at moneyunderthemattress.podcast@gmail.com. Everything discussed in this podcast is our opinion and should not be used as investment advice. This podcast is for your entertainment and education purposes only, and we hope that you enjoyed it.